Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Oil. Boy, been on a wild ride lately, to say the least. That's today's topic on the College Investor Audio Show. Welcome! Specifically, we're talking about how to invest in oil. So, it was trading in the mid-50s in February, and then West Texas Intermediate fell to negative $37.63 on April 20th. The plunge was, of course, due to the coronavirus, as demand for oil dried up, and storage swelled. Negative prices reflected the fact that futures traders were willing to pay someone to take delivery of their oil. How do you invest in such a volatile commodity? There are a few ways to invest in oil, some more volatile and risky than others. Brokerages. To start investing in oil, you want to open an online brokerage account if you haven't already. Many brokerages now allow you to buy stocks and ETFs commission-free. Once Charles Schwab announced back in October of 2019 that they were moving to commission-free trades, all other brokerages had no choice but to follow. Other commission-free brokerages include E-Trade, Ally Invest, and Fidelity. There are fractional share brokerages as well, such as Robinhood, also commission-free. ETFs and mutual funds. ETFs are a very common way of both investing and trading oil, but likely more suited to traders since ETFs can be traded intraday. One such ETF is USO, the United States Oil Fund LP. It tracks the daily price movements of West Texas Intermediate WTI, light sweet crude oil. USO has an expense ratio of 0.76%. ETNs, exchange-traded notes, are another possibility for trading oil. ETNs are unsecured debt instruments. Be careful with ETNs, as they can be riskier than ETFs. Oil, or OIL, was a frequently traded ETN that used to track oil futures. However, when oil futures went negative this year, the ETN shut down. In comparison to the mutual funds, USO is one of the closest ways to invest in oil without trading futures or options. You can invest or trade USO with nearly any brokerage. For longer-term investing, the Vanguard Energy Fund Investor Shares, VGENX, has an expense ratio of only 0.37%. You can invest in VGENX directly through Vanguard. There is no transaction cost or commissions. All costs are rolled into the expense ratio. VGENX can also be purchased and sold at other brokerages. Watch cost on other mutual funds, as their expense ratios can be high. The Fidelity Select Energy portfolio has a 0.87% expense ratio, for example. The Natural Resources Trust has an expense ratio of 1.19%. These mutual funds don't invest directly in oil, but give you indirect exposure by investing in oil-related and various energy companies. Oil stocks. Rather than investing in a mutual fund that contains several energy-related companies, you can pick specific companies to invest in. Stock picking takes more research and time. You want to make sure the company you invest in is sound. However, a good starting point is to choose the same companies that energy mutual funds are investing in. Oil-related stocks include those in the oil industry, such as drillers, producers, and rigs. These include Chevron, ExxonMobil, Royal Dutch Shell, and Phillips 66. MLPs. An MLP is a master limited partnership. These are energy stocks that pay high dividends, or in the MLP world, distributions. Distributions are often paid quarterly. Each MLP is a publicly traded partnership. Buying shares of an MLP stock means you are a partner rather than an investor. This type of structure also means that you'll pay taxes only on the distributions. MLPs may not appreciate as much as oil and energy stocks. However, that doesn't mean they can't be volatile. During March of 2016, many MLPs suffered big losses as oil plunged. Futures and options. Futures and options aren't really an investment. They are closer to trading. With futures, you have to keep rolling from one month into the next to hold a continuous position. Options can also be rolled, or you can trade LEAPs, leaps, which are one-year options. Trading futures and options are the highest risk way to gain exposure to oil. Futures are the most direct. Risk comes in the form of leverage that is used with futures and options. Leverage goes away with options if you are trading in a cash account instead of a margin account. A margin account is required with futures. It takes experience and skill to successfully trade futures and options. When commission-free stock trading was introduced, base rates for options went away. Now, traders only have to pay a commission on each option contract, usually around 65 cents. Futures also have a per-contract fee of around $1 to $1.50 per contract. As with any investment, limiting your exposure to oil can help protect your portfolio if things in the oil sector take a downturn. Oil is a volatile place to invest, but that doesn't mean you shouldn't. Just don't let it become a major holding in your portfolio. I hope that was helpful for today, and that's pretty much all we have. If you found this helpful, you can help somebody else out. Feel free to share this podcast with anybody, friends, family, whatever. We just want to help you out. And if you have any other questions or you want to see some more resources about investing and trading and paying down debt and tons of ideas on different side hustles you can start too so you can invest more, it's all at thecollegeinvestor.com. Thanks again for tuning in today. We'll talk to you again very soon.